Kia ora and welcome to Partnership, how to do the Partnership Internal. This partnership is for Tuakana Partnership. What we've got is Koro, who owns a fishing fleet that's feeding his family. That's the whole reason for being and bringing on a new partner for Kawana. This stuff here in the introduction is very important when you write the report. What we're going to do in this video is look at the formation entries and the entries for profit distribution. If you can open up those files and work through as well. It's on video, so you can press pause and slow down as we go. So first thing we're going to do is the formation entries. We've got here Koro's original business called Koro Fisheries, and we're going to bring in Kawana. So the partnership agreement tells us that we're going to bring in the assets and liabilities at their agreed value, except the following. And so we're going to put these ones in first. What I encourage you to do is to change these figures here, so you only bring the right figures in. I think your one that says the original 62,500. So what we do is firstly, Koro's going to write off 2,500 in bad debt, so we're going to change that to 60,000. So on yours, cross off 62,500 and write 60,000. That's before the new partnership's been formed. The agreed value of the remaining accounts receivable is 58,000. So we're going to put that into your journal entries. We're going to type debit to accounts receivable of the 60,000. And somewhere down the bottom here, we're going to credit allowance for doubtful debts. Of 2,500 debts. The reason for that is we think that we'll still be able to collect that 2,500. Well, it's still able to be collected, and so we're bringing it in, showing that we still can collect that debt. The next one, the assets and liabilities over the carrying amount. Carrying is basically this figure here, except the equipment. So we'll bring in bank as our next asset, bringing all of these in. You've just got to be a little bit careful. Sometimes the question says that not to bring bank in. We've got equipment, and it tells us the equipment's going to be valued at 65,000, and the boat will be at the carrying amount because there's no change of 500,000. The next line is goodwill, which we're going to have to calculate, and then we're on to our credit entries. So we've got accounts payable, GST and loan. In the credit column. As you're doing these, just make sure that you indent your credit. I press space bar 5 times. And lastly, your loan. Oops. So we've brought in the debits, brought in the credits, the capital we'll bring in as well. But this time we're going to call it Capital Koro. And sometimes we have to work that out. So in this case, Kawana is going to contribute 200,000 for a third share. Therefore, Koro will have a third share, which is twice as much as that. So if Kawana has got 200,000 for a third share, Koro's share must be 400,000. The valuation of a 2/3 share. And now we go back and calculate. So that's an excellence mark. Important to get that right. Calculate goodwill. That's a balancing figure of all your liabilities. If you add those up, minus adding up all your assets. Just check out the formula and type that in on yours. And 123,000. 63.5. Equipment 65. Yep. 500. 64. 12.6. Okay. And then we'll bring in Kawana's contribution. Kawana's paying money, so he's putting bank in. And capital goes to Kawana. Right, that's the end of the formation entries. If you just scroll across, you'll see the profit distribution entries. I've already put these in. They won't be there in the assessment for you, but I just want to show you how it works. So we're going to scroll down. Note that this one's a year and a bit later. So we're looking at the year end 31st of December 2022. Partnership was formed in 2020. So we've got to find out what the opening profit was. It tells you 270 here, but it'll also be in the trial balance down here. So we're going to put our profit at the start. And the idea of the profit distribution statement is to get all that profit to the partners based on their agreement. So that's the starting profit, and we'll scroll down to find out what the agreement says. Good way to do it is just work down bullet point by bullet point. So we're going to put the salaries in. Kawanga's salary is 80,000, and Koro's salary is 25,000. Add those two together. And we're going to take that away. So we've got opening profit minus what we've distributed to each partner for their salary. Then we've got interest on current. Current account charged or credit at 10%. If we look at the current account, you'll see that Koro's got 5,000, Kawana 2. Both of them are credit balances. So what we're going to do is, sometimes, these are debit balance. So we'd put a negative figure here. But in this case, we can work it out in our heads. Koro has 10% of 5,000 and 10% of 2,000. Add them together and take that away from the total. Interest on capital. Just got to always check the interest on capital. It's on the opening capital. In fact, the opening capital figures we're going to use in this one is the 300,000 figures. So we've got 300,000 times 10%. To say 10%, it is. So that'll be 30,000. Sometimes you have in the average balances where we've got part of a year until somebody brings something in. This one's much more straightforward. So if it was like a quarter of a year, they added an extra amount, you'd multiply the extra amount times quarter of a year times 10%. In this case it's not. Take that away. And interest on advances. See that 5% on the opening balance, and you'll find that Koro's got an advance of 5,000, 5%. So we're just going to take that, what do we say, 50,000 times 5%. Right, and that residual profit, we're going to split that based on the opening balances. Because the opening balances were equal, they split it equally. Very important that we're going to end up with a zero figure. We have to make sure that we allocate all that profit. So without that figure there, you get not achieved. So we need that one in. Right, now we're going to put it into their accounts. Again, these ones won't be written in the exam for you. I've put it here just to show you how it works. So start off with our current account opening balance. You'll see that Koro had 5,000 credit balance. It's on the credit side. And Kawana had 2,000. So that means they've got in funds. Now you'll see in here we've got a capital here, and this is a transfer from the capital account to the current account. So we have to read through and find out what happens. And we'll find that on the 31st of December, Kawana contributed 1,000 to his current account, and Koro transferred 100,000 from his capital to his current account. So it's going into his current account. For Koro, we're going to put 100,000 in. And Kawana, the opposite, he's having 100,000 coming out. So that's as a balance of power, and that'll play out in the report that we write next. So what we're going to do is put the rest in. So the salary, these are straight from the profit distribution. So salary for Koro was 25. The salary for Kawana was 80. These are addition, a reward, so it's going to increase your account. The interest on capital for Koro, and interest on capital for Kawana. The interest on current, both of them have a reward. If it was a penalty, it would be on the debit side. Koro's got the 500, and Kawana's got the 200. Interest on advance. So basically everything in this profit distribution statement has made its way through, and residual profits. Each one of these you put through, that's an extra mark, so that's great. And then lastly, drawings. Drawings you're going to find here. Koro's got 200,000. Drawings will reduce his account. And Kawana's drawings are only 55. Not quite finished, we've got to put the balances in. Koro's is quite easy. We're going to start with equals the opening balance plus any credits minus any debits. So a credit and credit increases minus a debit, and then big plus, put your mouse over the bottom right hand corner, black plus, left click and drag down, and that'll fill down to us. So Koro's got a 13,900. We could do the same with Kawana, but you'll see a problem. I'll show you. Opening plus the credits minus the debits, and you'll see as we fill down there's a negative figure, so we don't want a negative figure, so that'll be 98 and 18. See how it swapped from a credit to a debit, so basically that's a negative there. And then in here, what do we got? We've got 18, and then is that right? We've got 98. Salary 18, 30 goes in, so that's going to be a credit there. And we can fill that down. It's got 8,000 in the end, so 2,000 becomes a debit. The salary reduces that, turns it back into a credit, 18 minus that 30, and then adding the 2, the 50, and taking away the 55. Brilliant. At the start of the year, we're going to put balance and had 200,000. Whoops, 300. And then transferred 100,000 out of that's this part here, transferred 100,000 from his capital to his current, so out of his capital and into his current, that one up there. So that'll take Koro's capital down to 200,000, and Kawana's opposite was 300,000. And transferred it in. Just make sure you get the date right. 31st of March, that's when the transfer happened. There, done. Great. And then the last part is the statement of financial position note. So Koro will put his capital and Kawana's capital. The current for Koro, current. Just make sure these are credit balances. Koro's got that 50,000, and then we'll just sum. That gives Koro's total, and we'll also add these up and fill across. And last thing, the capital is that figure, and the current is that figure, and advance is that figure. All done. Alright, next video is going to be on writing the report.